Hi, my name is Kyle Dahlgren, and I, on behalf of our analyst team, including Michelle Berger and Jing Hu, would like to welcome you to our Fall 2015 Birkenroad presentation on the continuing coverage of IBERIABANK. During this presentation, we will give a background behind IBERIABANK, its stock price, and its operations. We will also present an overview of the industry, IBERIABANK's peers, and a risk analysis, and we will finally conclude with our stock valuation and investment thesis. IBERIABANK was founded in 1887 in Lafayette, Louisiana. It is the oldest and largest Louisiana-based bank. Although IBERIABANK began as a bank holding company, it became a financial holding company. IBERIABANK Corporation since then acquired 4 subsidiaries: IBERIABANK, Lenders Title Company, Iberia Capital Partners, and Iberia Asset Management. IBERIABANK has 326 combined offices in total. The company has 226 bank branches in 7 states, 87 in Louisiana, 65 in Florida, 32 in Arkansas, 17 in Alabama, 9 in Georgia, 9 in Texas, and 7 in Tennessee. Due to changes in operational strategy and technology, IBERIABANK plans on decreasing its overall number of branches in coming years. IBERIABANK has experienced gradual increases in stock prices due to a substantial amount of acquisitions. The company averages about 2 acquisitions a year and relies on them as part of their growth strategy. The company also places great importance on integration with these new banks. At the beginning of 2010, IBERIABANK saw a drastic increase in its stock price. This increase is primarily due to the 5 failed banks the company acquired during and after the 2008-2009 recession. In early 2014, the company also acquired 6 branches of Synovus Financial, peaking the stock price at $72.41, which is the highest stock price to date. Finally, in 2015, IBERIABANK acquired 3 more banks, including Florida Bank Group, Old Florida Bankshares, and Georgia Commerce Bankshares, spiking the price once again. Numerous other peaks in historical stock prices are attributable to acquisitions, and the company intends to keep up this acquisition strategy in future years. IBERIABANK's product lines include retail, commercial, private and online banking, mortgage lending, treasury management, and investment services. Legacy loans and deposits prove to be the company's primary services, with interest on loans as the primary source of revenue. IBERIABANK's loan portfolio is very diversified and heavily commercial-based. The company plans to increase the proportion of non-commercial loans in the future to further diversify its portfolio. However, the company is looking to reduce energy loans to compensate for current energy industry risk. For IBERIABANK, mortgage loans are becoming the major source of profit. In the industry, new regulations by the SEC will cause many companies to consolidate. Additionally, changing technology may cause banks to become smaller. The banking industry has a low threat of entry. New banks are unlikely to form because of high initial costs and strictly imposed regulations, which deters new entrants. In addition, existing banks already cover most available regions and have larger customer bases, making it difficult for others to enter. Bargaining power of buyers in the banking industry is also low. Switching from one bank to another could lead to high costs and be tedious for the buyer, and many customers choose to use one bank for all of their needs. The bargaining power of banks is high, mostly due to these high switching costs for consumers, consistent interest rates among banks, and locational advantages. As high switching costs deter many consumers from switching banks, financial institutions have leverage in terms of fees and certain interest charged. The threat of substitutes for regional banks is high. Many other financial providers and credit unions offer similar services, occasionally at a cheaper cost for the customer. Finally, IBERIABANK faces direct competition from many other banks in the Southeast region. Direct competition comes from Hancock Holding Company, J.P. Morgan Chase & Company, and Regions Financial Corporation. As IBERIABANK continues to grow, it may face the threat of acquisition by some of its larger competing banks, such as J.P. Morgan Chase and Regions Financial. IBERIABANK's primary peers were chosen based on similarities in product and service offerings, regional location, and market capitalization. The company's peer group consists of Hancock Holding Company, Bank of the Ozarks, Trustmark Corporation, First Financial Bankshares Incorporated, and Bancorp South Incorporated. IBERIABANK ranks slightly below the industry average for many ratios. However, IBERIABANK is within reasonable range of the industry averages and has established initiatives to improve their relative performance. IBERIABANK's financial success depends heavily on the economic conditions of the states in which it operates. If any of these states are in a recession, demand for IBERIABANK services could substantially decrease. Operational risk specific to IBERIABANK include operations in the Gulf Coast region, where both hurricanes and energy industry volatility pose a threat. However, IBERIABANK continues to limit its energy industry exposure in its loan portfolio to hedge against this risk. Although this exposure may not directly impact IBERIABANK, primary customers may be negatively affected by the energy industry downturn, creating an indirect effect on IBERIABANK's ability to collect on loans. IBERIABANK's main financial risks include liquidity and credit risk. Liquidity risk is the risk that banks fail to meet short-term financial demands. Liquidity is measured through the loan-to-deposit ratio, which, if this ratio is high, may indicate that the company has high liquidity risk and may not be able to recover sufficient cash to pay off its deposit liability. IBERIABANK currently has a high loan-to-deposit ratio compared to its peers, indicating potential liquidity risk. For regulatory risk, IBERIABANK must follow all regulations set forth by certain state and federal agencies. IBERIABANK currently meets all regulatory requirements. However, the possibility of new regulations is always a threat. The methods we used for stock valuation include P/E ratio, P to TBV ratio, and the dividend discount model. We gave IBERIABANK a rating of market perform with a target price of $74. IBERIABANK has completed 25 acquisitions since 2001 and will likely continue to expand through acquisitions in coming years. As IBERIABANK acquires other banks, the company assumes new branches, loans, and loan prospects in the various geographical regions acquired, which will foster continued success for the company. Furthermore, a large concern for companies and investors right now is the volatility in oil prices. IBERIABANK realizes this risk associated with energy loans and has decreased the percentage of energy loans in its portfolio in recent years and plans on continuing decreasing in the future. Another concern of investors is the company's relatively high efficiency ratio, which measures operating expenses as a percentage of total revenues. IBERIABANK has implemented numerous cost-saving initiatives to improve its efficiency, all of which have proved effective in the past. The company also looks to protect its high asset quality and does this by diversifying its loan portfolio and implementing strong credit policies to minimize the number of defaults on these loans. Finally, the Federal Reserve has discussed raising interest rates in the near future, which may lend to higher profits for banks.
The Altman Z-score, a test developed by Edward Altman in 1968, is used to assess the risk of bankruptcy for publicly traded companies. The Z-score formula focuses on a company's liquidity, strength of the balance sheet, and earnings power. However, this test is difficult to apply to financial institutions, such as IBERIABANK. IBERIABANK's current Altman Z-score is 0.21, indicating consistently low rankings on the Altman Z-score financial performance scale. This is a common score for banks. Texas ratio is an alternative measure that is a better indicator of bank performance. This ratio compares a bank's non-performing assets and loans to the firm's tangible capital equity and loan loss reserves. A ratio of more than 100 indicates financial distress. IBERIABANK's Texas ratio, as of third quarter 2015, is 11.29, which indicates a low risk of bankruptcy. In his best-selling book, One Up on Wall Street, renowned mutual fund manager Peter Lynch created a powerful charting tool for valuing companies. The Peter Lynch chart compares actual stock price to a hypothetical stock price determined by multiplying earnings per share by a theoretical price-to-earnings ratio of 15. The theoretical price is represented by an earnings line, which serves as the benchmark to determine whether a stock is worth buying. At times when the actual stock price is below the earnings line, Peter Lynch would advise investors to buy. When the actual stock price far exceeds the earnings line, Peter Lynch would advise investors to sell. IBERIABANK is trading slightly above the earnings line at $63.45. So Peter Lynch would suggest either to hold or sell the stock. The father of value investing, Ben Graham, created a valuation approach to determine whether a stock is attractive enough to purchase. This approach involved an 8-hurdle process, only 6 of which apply to banks. If a company can pass 4 out of 8 hurdles, its stock would be worth purchasing. IBERIABANK passed 5 out of 8 hurdles, and therefore is an attractive buy according to Ben Graham. In conclusion, we rate IBERIABANK as a market perform with a 12-month target price of $74. We believe IBERIABANK will continue to prosper through organic growth, limited energy industry exposure, and improved operating efficiency. Birkenroad reports are produced solely as part of an educational program at Tulane University's Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. Before investing, you should consult a professional investor and/or your own primary research. Thank you for listening.